The program examines the risk and performance characteristics of private and listed alternative assets, with particular emphasis on the differences between public and private investment structures. Private assets, such as private equity and private real estate, often appear to generate superior returns relative to listed assets, but these comparisons are complicated by valuation methodologies, illiquidity, leverage, and risk exposures. Listed assets provide daily market pricing and greater transparency, whereas private assets rely on periodic appraisals or manager estimates that may smooth reported volatility. The program emphasizes that investors must carefully evaluate performance metrics, liquidity conditions, and valuation practices before concluding that private assets consistently outperform listed alternatives on a risk-adjusted basis. Illiquidity premiums represent one of the central arguments supporting investment in private assets. Investors generally require additional expected returns as compensation for committing capital to assets that cannot be traded easily or quickly. However, the program explains that illiquidity premiums may also exist within certain listed assets, particularly small cap equities, distressed securities, or thinly traded real estate investment vehicles. The relationship between illiquidity and return is complex because illiquid assets often exhibit higher transaction costs, valuation uncertainty, and delayed price discovery. Furthermore, appraisal-based valuation methods may artificially reduce measured volatility in private markets. As a result, some observed outperformance of private investments may reflect valuation smoothing rather than true economic superiority over comparable listed assets. The program also explores the real performance characteristics of private and listed real estate investments. Private real estate investments often appear less volatile because appraisals adjust more slowly to changing market conditions. In contrast, listed real estate securities, such as REITs, react immediately to economic news, interest rate expectations, and investor sentiment. Over long investment horizons, however, the fundamental performance drivers of private and listed real estate may converge because both ultimately depend on property income, occupancy rates, and asset appreciation. Listed real estate generally offers greater liquidity and transparency, while private real estate may provide access to operational improvements, redevelopment opportunities, and illiquidity premiums. Investors must therefore distinguish between true economic performance and differences caused by valuation methodologies or market structure. The PME, or public market equivalent, method is an important tool for evaluating private asset performance relative to public market alternatives. PME compares the cash flows of private investments with hypothetical investments in public market benchmarks over the same period. This approach helps investors determine whether private asset managers truly generated excess returns beyond what could have been earned in public markets, with similar timing and risk exposure. The program emphasizes that PME analysis overcomes some weaknesses associated with traditional IRR calculations by incorporating opportunity costs and market comparability. Various PME methodologies exist, but all seek to provide more meaningful performance comparisons between private investments and publicly traded benchmark portfolios. Multiple evaluation tools are necessary because no single performance measure fully captures the complexity of private asset investing. Common measures include internal rate of return (IRR), multiple on invested capital (MOIC), distributed to paid-in capital (DPI), and residual value to paid-in capital (RVPI). Each metric provides different insights regarding profitability, cash flow timing, and unrealized value. However, the program highlights important IRR aggregation problems that can distort performance interpretation. IRR is highly sensitive to the timing of cash flows and may overstate returns when early distributions are reinvested unrealistically. Aggregating IRRs across multiple investments can also produce misleading conclusions because IRRs are not additive. Investors therefore rely on multiple complementary metrics to evaluate private asset performance accurately. The program also discusses criticisms of private equity and the debate regarding access through private versus listed structures. Critics argue that private equity returns may be overstated due to leverage, valuation smoothing, survivorship bias, and selective reporting practices. Others question whether private equity consistently outperforms public markets after accounting for fees, illiquidity, and risk. Despite these concerns, supporters emphasize the value of active ownership, operational improvements, and long-term investment horizons within private markets. Choosing between private and listed access structures ultimately depends on investor objectives, liquidity preferences, governance capabilities, and tolerance for complexity. Listed structures offer transparency and flexibility, while private structures may provide access to unique opportunities and potentially higher long-term returns through active management and illiquidity exposure.